And you said durables is coming too. Steve, thanks so much. I appreciate that very much. That's Steve Leisman, our senior economics correspondent. Let's bring in now Chris Verrone of Strategas, who's with us. I mean, there's so much to potentially kick around here. The notion of some level of progress. We don't necessarily need to define the progress. It's the notion of that seems to be good enough for the market, at least in this moment.
Well, I think this distinction you and Steve are making between hard data and soft data is an important one, but I'm not sure the market is as focused on that here. And in particular, the market's not distinguishing between the soft data being weaker than the hard data. When you look at cyclicality peaked, I think, the third week of November. So cyclicals have been weak long before this. You've seen it with consumer discretionary. You've seen it with the industrial. So whether or not the hard data catches up to the soft data, the market's certainly behaving as if it's a moot point.
Well, the market's placed its bet that hard data is going to be bad.
Yeah, and I think that's really what's endemic about downtrends. We talk about the volatility today. You know, S&P up 2.5%, coming off a 2.5% down day yesterday versus a 9% up day a few weeks ago. That type of volatility is very endemic to what one expects when the trend is down.
What are you watching more than anything else at this very moment?
I'm watching two things. I would say, number one, when you're in these downtrends, you have to raise the bar for what you want to see on the inside of the market to really escape out of this. We look at the internals very seriously. What we want to see is advanced decline skews that are overwhelmingly positive. So far, we've had one really good internal day. That was that April 9th day. I think we were 35-1 advancers to decliners. When you look at every major market bottom in the last 100 years, you'll see those very strong days start to cluster one after the other. Internally, that's what we want to see. From a leadership perspective, I want to see the market assume a more cyclical bias. That has not happened on this bounce yet. You look at the rally over the last 2 weeks. Staples have been better than discretionary. Utilities have held their own. Right. So it really hasn't assumed a pro-risk type of configuration yet.
But that speaks to sentiment to a large degree as well. If you have, incremental headlines that suggest some positivity towards whatever, the outcome is going to be with China, then theoretically you'd have a fair amount of buying in cyclical areas of the market because you're going to place your bets in advance that the markets and the economy is going to avoid the worst outcome.
Scott, it still feels like we're in the high volume, high drama headline phase of all of this.
Oh, for sure. And I want maybe for a while.
And I want to get this market to the lower drama, lower volume, almost the feeling of neglect or giving up. And, I recognize that the sentiment data has been very lopsided here, but I don't get the sense that investors have given up here yet. And, that's one of the necessary ingredients of ultimately putting in a good low. I don't think we have to go a lot lower here. 4,800 discounted a lot of bad outcomes. But the process of repairing the trends and basing after the damage so many stocks and sectors have endured, I think is important. And, let's add to that, Scott. One thing we haven't seen yet, we haven't seen the stuff people, the stuff that people view as most defensive or safe. We have not seen that really get hit yet. That could be Costco or Walmart or gold. I think ultimately the safe stuff has to get hit here too.
You make an interesting distinction between, what some on the street and the notes this week have talked about, the psychological versus physical.
Yeah.
That psychologically sentiment's terrible, but large institutions and clients per se of, Bank of America, for example, and they track the fund flows, hasn't necessarily turned into mass selling. Psychologically, not necessarily physically. Right. There's a difference between the two, obviously, in the outcome of a market.
Yeah, and that's what I think still has to thaw here a little bit. I mean, we were 2.5 years up with basically little interruption, and we're 5 or 6 weeks down. Now it's been a large decline. I do think 4,800 is probably a good low, but the process of retesting and basing is in front of us. I would also just note, when you're looking for unusual or extreme price action, what we've seen in gold, Scott, the last couple days is both unusual and extreme. And this has all the makings of some type of a blow-off there.